Welcome to another ESSSuper investment update. 2018 was a great year for diversified investors. Robust economic growth, subdued inflation, and reasonably accommodative monetary policy underpinned positive returns from most asset classes. Financial year 2018 was a year of two halves. The first 6 months to December was characterised by synchronised economic growth and low volatility across most major markets. The last 6 months saw volatility increase as the US economy sped past Europe and Australia and began to raise their interest rates as inflationary pressure grew. Protectionist trade policies, political tensions around the world, and falling house prices in Australia all added to uncertainty and weighed on returns. Despite more volatile conditions, diversified funds fared well over the year, particularly funds invested in domestic and international equity markets, which generated double-digit returns. Unlisted property and infrastructure returns also benefited from the positive growth environment, supported by strong investor demand for cash-generating assets, and that was particularly the case for offshore investors. Bonds generated positive returns in the low single digits, being weighed down by low yields and rising US interest rates. The Australian share market ended 13% higher for the year and has generated positive returns in 8 of the last 9 years since the global financial crisis. The energy, materials, and information technology sectors drove the bulk of the local share market performance, whilst the telecommunications stocks slightly detracted over the period. Smaller companies outperformed larger companies, boosted by positive growth momentum and benign volatility in the first half of the financial year. The US share market led the way, with the S&P 500 ending the year 14% higher after robust profits were met with US tax cuts. US shares were driven by a small number of large disruptors being companies like Amazon or Facebook that have revolutionized their respective industries. European shares posted positive but low returns, impacted by slowing economic growth in the Eurozone and political instability, which included Britain's exit from the Euro and mass migration. Robust share market returns were underpinned by global economic growth and accommodative interest rates. This year, however, the US Central Bank has increased policy rates 3 times over the year to 2%, while the European Central Bank has started reducing its accommodative monetary policy. Share markets are looking at how company earnings respond to tightening economic conditions. If policymakers tighten too quickly, share markets will correct. If they tighten too slowly, inflation will pick up. The Australian economy appears in good shape. Growth remains positive and inflation is in the lower end of the RBA's target of 2 to 3%. Falls in house prices, as well as our trade links to China, are 2 key risks to the local economy. The Australian dollar is at its lowest level in 2 years at 73 US cents. Talk of a trade war between China and higher US rates have put pressure on the Australian currency. A recovery in commodity prices, boosted by demand for Australia's exports, to support our currency from falling further. Diversified portfolios performed well over the year, with growth-exposed assets delivering particularly strong returns. Cash and bonds provided low but positive and steady returns. All of our member investment choice options performed in line with their respective investment objectives in terms of the risk and the return. The accumulation plan remains well diversified, with a particular focus on downside protection. ESSSuper will continue to manage the accumulation plan to deliver optimal retirement outcomes for our members, and we look forward to presenting to you in the future. Thank you.